Welcome to today's course focusing on money and risk management. Please bear with us. This is the most important lesson in all of your trading career. Managing money and risk is the difference between making or breaking. The outline, little disclaimer, and our focus for today again, money management and risk management. Disclaimer, be careful when trading with actual life funds. Trading is highly risky. So money management. Little overview, we're going to go into TradingView to look at a couple of examples for each topic. And please pay attention. Again, that's the most important lesson in all of your trading career. Money management. Protect your account from unnecessary loss. So managing your risk well means calculating position, using stop losses, and focusing on risk reward. Targets and rules. You need to have targets and rules. So daily win targets, maximum potential loss on a weekly and monthly basis even. In the long term, newer traders like to calculate how much money they can potentially make and focus less on how much they could lose. So please take that into consideration. Let that sink in for a second. The most important thing to consider, how much could I lose potentially rather than win? Protecting your money is of utter importance. Sound money management will be crucial to always protect your account and trade without stress. There are a lot of psychological factors here that we're also going to cover in the next sessions. So let's look at a couple of examples. Money management. Calculate your position size. There are a lot of nifty tools inside of TradingView that will help us to actually calculate position size and risk reward. We're also going to look at online calculators later on. Target and rules. When you enter a trade, make sure that you have a predefined target and a predefined stop loss level. These are crucial when it comes to your success. A little checklist here. What's the size of my position, right? Where do I place my SL? We're going to refer to stop loss as the SL throughout all of our sessions. How many are? We're going to focus on what is risk reward and how do we define 1R? What's my daily target? What's my max loss that I'm willing to take on a daily basis? Those are all things that are really, really important, guys. So let's head on over and focus on risk management. Risk management is the key to being profitable in the long run. There is no other thing. Risk management is crucial. First, learn how to trade, protect your account, and then start thinking about making money. Take time to understand the importance of risk management. Set up rules and never break them. The risk level, start small and earn the right to raise your risk. After, let's say, 3 months of practicing on a demo account or a small live account, we'll focus on calculating position size and applying those rules. So let's look at a couple of examples here. We're back in TradingView. Now, TradingView allows us to use so-called long and short position tools. We're going to look at these tools in a second that will help us protect our money, help us manage our risk by using them and having clearly defined levels, risk levels. We will be protected from losing all of our money. So a little checklist here. Protect your account. Again, I cannot stress that enough. Protecting your account is your number one job. Risk only a portion. Start small. We're going to focus on that and how much to actually risk per trade. Again, define rules. What are the rules on a daily basis, on a weekly basis, on a monthly basis? Rules and targets. Never break those rules and plans that you are putting in place for yourself. Stop losses. Stop losses are part of a trading plan. They are part of your daily trading activity and are crucial protecting your account from losses. There are levels in the market that are invalidating your ideas. They are being executed automatically. And once you figure out how much risk you're willing to take, a stop loss level for each trade should be determined and placed accordingly. Never move your stop loss if a trade is unfavorable. Adjust the position size. Maybe your position is too big. Trade using the same parameters on every trade, regardless where your stop loss is. And let's have a look at some examples on TradingView. Stop loss placement. Inside of TradingView, we have a nice tool that visually represents stop loss levels and targets. Again, if I'm repeating myself, I'm stressing the importance of this topic. Stop losses are there to protect you from unnecessary loss. So in this example here, we've placed a so-called long position tool, a marker that shows us an entry price here, a take profit target, and a stop loss price. This is a hard stop loss. If this trade is going against you, you will automatically be stopped here, taken out of the market, and be safe. So a stop loss is nothing bad. It's protecting you. It stands between you being successful and profitable or not in the long run. So a little checklist again, and ingrain that. Always use a stop loss. Never move it. Just because a trade isn't going in your desired direction, don't try to tweak it and move it. Use the same risk on every trade. This is what your plan dictates. Never break the plan. To demonstrate that very fast, you've got tools in here that are called long and short position. I'm going to use the long position tool and I'm going to place it here. Let's say I want to take this trade long with a gap over here. Boom. I'm going to use a $1,000 account, 1% risk. So my target is up here and I would be making $13 on this trade. And if it goes down, the maximum loss that I could take with my stop loss is $10. So my account will lose $10. But if you are not setting stop losses, your loss can be infinite and your account liquidated. Keep that in mind. Risk reward ratio, R&R, sometimes known as the R&R, is a measure that compares the potential profit of a trade to its potential loss. So a ratio of 2 means you risk 1 in order to get 2. You risk $1 in order to get 2. You risk $10 in order to make 20. In this example here, we can see the tool inside of TradingView showing us a risk reward level of 2, indicating risk 1, get 2. The percentage of winning trades, also known as the win ratio, is the amount of total number of winning trades versus losing trades. We're going to have a special section here where we are focusing on the win ratio on top of risk reward, and combined look at what these concepts mean together. Let's look at an example on TradingView again. Back in TradingView, risk reward, guys. R&R, using long or short position, is going to show us how much risk reward a trade has. So in this example, between the gray and the green area, this little black line, that's my entry. This is where I'm going to enter the market. my risk is 1% of my account. In this example, we're using a $1,000 account. And I can make a risk reward of 2, meaning I'm going to risk $10 here. If that happens, I'm going to lose $10, so my account will be down to $990. If I win 2, I will have $1,020. Yeah? That is my risk reward ratio, and you are going to see risk reward throughout your career. This is something that we're using on a daily basis. We're measuring the R we made per given trade, and we'll have plenty of examples in our percentage of winning trades section later on. Keep that in mind, guys. Stop loss combined with a nice risk reward ratio is what either makes or breaks your trading plan. Win-loss ratio. The win-loss ratio is a ratio between the number of profitable trades over unprofitable trades. Achieving a high win-loss ratio doesn't necessarily indicate that you're a successful trader. A win-loss ratio that exceeds 1 indicates that out of the trades you made, at least half were profitable. So an example, you do 10 trades and you win 7 trades and lose 3 trades. That means we have a win-loss ratio, 7 and 3, 2.33. For simplicity, we are going to use percentage numbers. As we can see down here, you're doing 10 trades, you're winning 7, you're losing 3. That's a 70% win rate. So more often, we're going to use percentages to indicate the success rate or win ratio of our trades. So focus on percentages here. Out of a total amount of trades, how many percent of the trades have you been winning? And to illustrate a couple of examples combined with risk reward, we've put up something on TradingView for you. Back in TradingView, we've put up 2 examples here of a win ratio and R&R. Example 1, we take 10 trades and our account sizes, our starting balance is $1,000. Now, 1R, we're going to risk 1% of our total account, which is $10. That's the maximum that we are willing to risk per trade. Yeah, remember that. So the target is to shoot for a risk reward of 1-to-1. In this example here, everything that is in gray, that's my potential loss, and everything that is in green, that's my potential winnings. So risk reward of 1 is showing me if I lose 1R, I lose $10. If I win 1R, I win $10. So in our example here, we're shooting for a win rate of 70%. We've made 7 winners with a total of $70. We've lost 3 trades at a total of $30, which gives us a net profit of $40. Yeah? Let that sink in for a second. Yeah? That's very, very important. Example 2. We take the same 10 trades. Our account size has the same starting balance. 1R, representing 1% of our account of $1,000, is $10 per trade. You are not going to risk more than $10 per trade with such an account size. The target risk reward is 1.5. We're shooting for 1.5 R per trade, meaning we risk 1 in order to get 1.5. Now our win rate has dropped. We've only won 50% of the trades. So we've got 5 winners and 5 losers, totaling $75 on our winners, and we've lost $50 on the losers. Gives us a net profit of $25. So you can see the difference here. sometimes less is more. Okay? And the better you get, the more you backtest, the more you train, you will improve your win rate, and you will also improve your risk reward, and you will find a plan that's right for you. We're giving you examples here, guys, of some minimum targets that you should be utilizing throughout your career. One more note on this topic. Every trader is going to lose at some point. Everyone. There is nobody out there that wins 100% of the time. But if you are managing risk reward well, and if you're managing your win ratio well, you will be profitable in the long run. Most successful traders are not having a 100% win rate. Keep that in mind. It's the stop loss, the risk management part that will make you successful in the long run. Doing that is like flipping a coin. You might be right 50% of the time. Yeah? It's a matter of statistics. The more you do it, the more you backtest, the better you will get. Yeah? This is not a casino. We're using stop losses to protect ourselves from bad decisions. Pips and lots. When calculating our position sizes, we need to first understand what pips and lots are. So a pip is an acronym that stands for percentage in point, and is commonly used in the foreign exchange markets, in the Forex market. A pip is a hundredth of 1%, as you can see here, and it appears as the fourth decimal place. In this example here, we've got a foreign currency exchange rate with 1 pip being the fourth decimal here, the smallest move the asset can do. Since we're not trading too much Forex here, we're going to focus on commodities more. We're talking a lot about lot sizes. And a lot size describes the amount of units bought. What is very important to understand is that lot sizes are being defined as standard lots, mini lots, and micro lots. Again, we are focusing on metals, on commodities, and we are trading CFDs. So these unit numbers are coming from the Forex market, and they are different in the CFD market. Since standard lots are too expensive to many new traders, the markets have introduced mini and micro lots to allow a larger audience to participate, you guys, without having to spend a fortune per position traded. So lots are calculated a little bit differently for Forex and metals, meaning the thing that we're going to focus on is the volume here. That's what the broker allows us to trade. And to illustrate an example, we've been preparing something in MetaTrader on gold to demonstrate what these numbers mean. So let's head on over to MetaTrader, and guys, remember these numbers: 1.0, mini lot 0.1, and a micro lot 0.01. And what that actually means, we're going to see in a second. All right, guys, so we are in MetaTrader now, and we are looking at XAU USD gold. We're trading a CFD here, so let me actually hide all and look at the actual contract. So I'm going to go into specifications, and I can see that the margin currency is USD and that the contract size is 100. So what does it mean? The current price of 1 ounce of gold is fluctuating here, $1,823. That means if we would buy 0.01, the contract size being 100, we will be buying with 0.01 lots, we will be buying 1 ounce of gold. If we would be buying 0.1, we would be buying 10 ounces of gold. And last but not least, since the contract size is 100, if we would buy 1 lot, we would be buying 100 ounces of gold, or 100 units of the contract. That's roughly $200,000 here. So keep that in mind. Lot sizing is important, but this is where the brokers are allowing you to trade at the fraction of the actual cost, meaning 0.01 allows you to trade 1 ounce of gold, 1 unit. That's the most common denominator that brokers are using and are allowing you to trade. We've also prepared some calculators. We're going to illustrate and show you some calculators that make it easy to determine lot sizes, to better understand. But I hope that this gives you a little bit of an overview on why that is and how it's being traded. So in the metals market, again, the important factor is the contract size here. So this has nothing to do with Forex. Keep that in mind. Position sizing. Position sizing is the part of your trading system that tells you how much of an instrument that you're going to buy, how many shares, how many contracts. The lot size is the number of units of that contract, of that asset you're buying. Position sizing will help you to determine how many contracts, again, the risk per trade, and overall risk to your portfolio, to your account, your expected returns. You can have the best strategy in the world, but if your trade size is too big or too small, you'll either take too much or too little risk. So you need to find the right balance. Let's go and have a look at an example on TradingView. So balancing your position size is crucial. Following again your trading plan, your risk reward targets, and your stop loss levels. So you see, all of these topics that we've just discussed are playing a crucial role here. And they're slowly coming together. Risk reward, position size, win ratio, all of these things are of uttermost importance. So here we can see how many units of an asset am I actually going to buy, versus our stop loss level. What is the impact on our total account size? If I have a drawdown of a certain percentage here, how will it impact my account, my portfolio? So balance the risk. Again, this has a lot to do with implementing a trading plan. You need to follow a plan and do the right thing over and over and over. Only this will make you successful in the long run. We're going to look at a couple of tools that should make it easier for you to calculate when you're actually trading commodities. We're back in MetaTrader and a little example of what the impact of lot size actually means. So we're going to place a small lot that means 0.01, which is translating to 1 ounce of gold. So we're going to buy the market here, and we're going to see our P&L opening up here. So it's fluctuating in pennies and cents. And we're going to do the same thing with a bigger lot size. So we're going to trade with 1 lot. So be careful when actually doing that. So I'm going to place a buy order here. And now you can see that the size is 1 versus 001. And you can also see that it's much faster. So I'm losing more and more money, or I'm making more and more money, as the price moves. So the fluctuations are big here. Keep that in mind. Since we're applying take profits, you can see if I'm using the big position here and we're at 18, that's about 25. That's a $1 move that will give me a profit of $29 here. But equally, I can lose $29 really, really fast. As you can see here, I'm already down $76, $80, $100. It's moving really fast. So risk management, calculating position size is crucial in order to make it or break it, to not gamble or use unnecessary risk. Keep that in mind. These markets are crucial and you're going to get burned if you're not applying sound risk management. All right, guys, calculating position size. And that's the part where we're going to talk about online position size calculators. Food for thought. We've prepared a trading journal for you guys that we're going to show in a short while, that has all of the position size calculations already integrated automatically in order to keep you safe. So bear with us as we're going to announce that. Why do we need to do that? We determine our balance, our capital, and our risk per trade. So the risk refers to the maximum loss, the 1R. So you remember, risk reward ratio. What is 1R? The maximum you can lose if your stop loss is being hit. And this loss should never be more than 1%. We've learned that already. Risk reward ratio, we're using 1% of our account, which is 1R. So the important part again, we're emphasizing this as often as we can, but it is important. We don't want to annoy you guys here, but we simply want to stress the point that this is important. To begin with a 1% risk per trade and earn the right to scale up. Again, if you're in a demo account, on a small live account, if you're successful, if you're having more winners than losers, then maybe in the future you earn the right to risk more. Lot size online calculators, that's what we're going to look at right now as an example of how we're actually doing that. We've navigated to an online calculator here, looking at gold USD. Opening price, $1,900. And I'm going to set my stop loss price at $1,899. So $1 move. My account balance is $1,000 and I risk 1%. I'm hitting calculate and my money at risk is $10. The units, the trade size is 10. How do we calculate that? I'm going to take the 10, I'm going to divide it by 100 because the contract specification, if you guys remember, on my MetaTrader was 100 for my gold contract. So if I use 10 units divided by 100, it's going to give me 0.1. So we're going back to MetaTrader and to see how much that is. We're back in MetaTrader and I'm going to use that 0.1 lot size to buy at market price. And you can see I have an open position here with a size of 0.1. I've bought for the price of X, and that's my current P&L. So we're at 1,824. That's my price, and that's my P&L. We can now adjust our stop loss equally. So as you can see, I can go down here. So that's my 1%. That's about roughly my 1% loss. And I can move that up to here to take my 1R winner. So we're looking at a risk reward ratio of 1. I'm risking one in order to make one. And since these markets are very fast moving, entering the market is equally important, but that's another topic for another day that we're going to focus on. All right, I hope this helped. And why don't we just take a second and look at that trade, and maybe it will actually work out in our favor. Let's see. Let's give it a couple of seconds and see if that does work out for us. The good thing here is we are protected. We have a stop loss in place. We have a take profit target. Nothing can happen to us. Okay. All we're willing to risk is $10 again. Yeah? So the market is fluctuating. We're currently on a 5-minute chart. Okay. And we can see like prices moving up and down, and our P&L, our profit changing. Yeah. So we're currently down 60 cents, 30 cents, and prices wiggling up and down all the time. And remember, guys, the reason we're using stop losses essentially is there can be long candles, long wicks that are stopping us out immediately. Yeah? These markets can be very volatile at times. Again, another good reason to use a stop loss. You don't want your loss to be infinite. So right now we've been pausing for a little bit, and let's see if this candle does actually move in our way. So we're at 50 cents break even. We're down $1, $2. Let's see what's going to happen on the next candle. Right, you can see the market is volatile. It's driving down, and it looks like we will be stopped out. So another second or two. Let's see what happens. We're going to pause it and see in a second. Here we go, and we are stopped out. Guys, great example in understanding why to use a stop loss. This can go down forever, and we would be losing all of our money. Keep that in mind. Markets are volatile, and they often go into the other direction. But that's why we're here, to practice entries, risk management, in order to beat the market at its core. Dynamic position sizing. We're having a discussion whether or not to mention this. We're going to cover it anyway to give you an overview what it actually means. It's a strategy in which you add lots to your initial position after the price has moved against your desired direction. It's being called DCA, dollar cost averaging, meaning you add as the price is moving against you. This will improve your overall entry. So in this example here, we start with a sell short. That means we're betting on falling prices, on prices going down. So the price is moving against us. We're entering again, and we're entering again as the price is moving against us. This will average out our total entry value, and we can start to take profit here as we go down. But please, this needs to be used with caution, because if your analysis is wrong, at some point you'll be in a position that is no longer worth holding. As you've just seen in our example, you will get liquidated. You will lose all your money. Keep that in mind. Using this type of strategy, people tend to not incorporate hard stop losses. That's very, very important. Don't use dynamic entries until you haven't practiced on a demo account and have lots of experience with traditional entries, limit orders, market orders. Those are all topics that we're going to cover. Okay, so again, keep that in mind. We've just mentioned it here in case you're coming across a strategy being called DCA. This is what it means. Risk parameters. So again, to summarize today, we've looked at risk reward, at position sizes, at win ratios. money management, okay? In general, you must be able to accept losing. Every trader is going to lose at one point, even if that means losing 10 trades in a row. But those 10 trades lost in a row should never, ever, ever exceed 25% of your account. Write that down in your plan and make sure to follow your plan. If you want to make it, follow rules, set up rules, and follow them. This is not being set in stone. It's a guideline that we're giving you. No more than 1% of your portfolio should be put at risk at any particular trade. We've covered that. Again, remember, risk reward, 1R being 1% of your account. Make sure to not risk more than 1%. It's unnecessary risk. You have to find the right balance between, we've looked at examples, between doing 1R or 1.5R. So again, stressing the point, you risk too little and your account won't grow. You risk too much and your account will be liquidated in a couple of bad trades. We don't want that. Our number one job, in order to recap this whole session, is to protect what we have in order to be sitting down tomorrow and starting to trade again. You can't trade tomorrow if you've lost everything today. Very important. And if you guys ever run into a bad experience on any of your trades in the future, bookmark this video, watch it over and over and over again as a reminder that this is important. Maybe the reason you've messed up is because you weren't following risk parameters. You did not put any rules in place. Keep that in mind. Watch this over and over. Write it down on your wall when you're trading. It's the thing that either makes it or breaks it for you. And with that being said, I will see you in the next one.